You can see how it's a situation which leads to loss of credibility in a fiat currency. It's not so much gold rising, it's the dollar going down. But we're not talking about the dollar against other fiat currencies. I mean, it is the king of fiat currency. We're talking about the complete fiat currency cohort meeting a problem. When gold starts running higher, silver runs almost twice as fast on average. Now that we see that gold is breaking out into the upside, we're talking about the price of it in dollars, then on that basis, I think we could well see that silver might catch up and run back up to that $26 level. So hopefully you'll feel a little bit more wealthy as a result of this.
The price of gold has surged to a record high, propelled by several factors, including growing expectations of U.S. interest rate cuts, investors seeking haven assets, and substantial buying by central banks and Chinese investors. On Tuesday, the yellow metal reached $2,141 per troy ounce, surpassing the previous record of $2,135 set in December, according to LSEG data. It then slightly retreated to trade up 0.8% at $2,131 for the day. Alasdair Macleod attributes this market surge to factors such as central bank purchases and increasing demand from the Far East, particularly China. Recent months have seen a surge in purchases by Chinese consumers seeking a safe haven for their cash amidst turmoil in local property and stock markets. What concerns Alasdair is the United States recently crossed a significant threshold, with its national debt surpassing $34.4 trillion. This translates to a concerning trend, an increase of roughly $1 trillion every 100 days. This rapid growth has sent shockwaves through financial markets and raised critical questions about the nation's long-term fiscal health. Adding fuel to the fire, credit rating agency Moody's Investor Service recently downgraded its outlook on U.S. government debt. Their reasoning: the rising debt levels and the potential for large deficits in the future pose significant risks to the country's fiscal strength. Economists like Alasdair echo these concerns, highlighting the potential challenges of servicing this growing debt, especially in a climate of rising interest rates. The U.S. government may encounter challenges in borrowing money if spending isn't curbed or revenue increases, leading to a debasement. This could hinder the government's effectiveness. The repercussions extend to financial markets, where investors seek safeguards against a possible decline in the U.S. dollar. Consequently, gold is viewed as a safe haven asset, attracting investors seeking stability amid economic uncertainty. We will present clips from Alasdair Macleod's interview with Liberty and Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
It's been a fascinating market because what's driven it to new high levels is really central bank buying, demand from the Far East. I mean, China. Bear in mind that the Indian economy has been growing at an enormous clip. And of course, it's creating, ultra high net worth individuals. Now, do they import their gold into India? No, they managed to get resources outside India, outside any exchange controls. And I should think they're probably stashing their gold in places like Switzerland and maybe Singapore. The demand from Asia is only just really starting. And also driving the price is the weakness of the dollar. We're suddenly beginning to realize that the dollar has got a debt problem. We've seen, goodness knows how many people remarking that in the last 100 days, outstanding Treasury debt has increased by a complete $1 trillion. And people are beginning to realize that in this current financial year, you're probably looking at $3 trillion of new stock, plus about, I think it's 7.6 trillion of refinancing. Now, who's going to buy it? This is a problem. And of course, we've been talking about this for some time, but you can see how it's a situation which leads to loss of credibility in a fiat currency. It's actually as simple as that. It's not so much gold rising, it's the dollar going down. Now, most people would think, well, the dollar is actually pretty steady. The trade weighted is 103.4 or 6 or whatever it is. But we're not talking about the dollar against other fiat currencies. I mean, it is the king of fiat currencies. We're talking about the complete fiat currency cohort meeting a problem. Now, that 3 trillion of borrowing in this current fiscal year, which takes us up to September, assumes that the US economy isn't going to slip into recession. Well, I tell you, it's already in recession. The only reason that the GDP numbers look good is because of the money printing or the credit printing by the Fed. Well, yeah, by the Fed, if you like, and the US Treasury. The US Treasury is spending this money into GDP. It's not productive. So the idea that the economy is looking good is not at all true. And so I would be very, very surprised if the US economy doesn't actually go into a deep slump. So what does that do to the borrowing requirement? We're looking not at 3 trillion, but we're probably looking at somewhere 4.5 trillion. And then you look at interest rates. Are interest rates going to go down when all this funding has got to happen? No. And not only that, but banks are still running scared of lending to small and medium-sized businesses. If there's a scarcity of credit, what happens? The price of it goes up. I mean, it's a no-brainer. It really is as simple as that. And then today we had the Bank of International Settlements came out with a warning that it looks like inflation is going to be around for a while. They made the point about enormous amount of debt that needs to be funded and all the rest of it. And consequently, they didn't see that interest rates were going to decline in the near future at all. So you can see there's a sort of awakening to this reality.
When a government operates with a budget deficit, it means spending more money than it receives in revenue. This results in the government borrowing money to cover its expenses. Alasdair explains that this borrowing effectively injects credit into the economy without a corresponding withdrawal. In an ideal scenario, this deficit spending could be offset by savers purchasing government debt, but the trend of decreasing savings rates in America disrupts this balance. Savings, as Alasdair highlights, represent deferred consumption. However, as savings rates decline, fewer funds are available for investment in government debt. Consequently, the deficit spending by the government is not balanced by a decrease in consumer spending, leading to an injection of credit into the economy. This injection typically results in a nominal increase in GDP. Alasdair estimates that the total GDP figures are around $30 trillion, and an additional $1 trillion injected by the government could potentially lead to a substantial percentage increase in GDP. Nonetheless, he acknowledges that not all government spending directly contributes to GDP growth. For instance, the interest costs associated with servicing the debt do not directly add to economic output, but instead flow into the banking system. Let's get back to the interview.
The government has a budget deficit. In effect, it is spending credit into the economy, which hasn't been taken out of the economy for it to spend. Now, what I mean by that is that if there was to be no effect on the purchasing power of the currency, then what you need to do is you need to get savers to save so that they can buy the debt. But if you look at the savings rate in America, it's actually continuing to fall. And so what that means is that the spending in the economy by the government is not being matched by the withdrawal of spending by the by consumers, because savings are basically consumption deferred. That's what economists refer to it as. So if there's nobody deferring their consumption, all this extra credit is being pushed into the economy, then basically your nominal GDP increases accordingly. And GDP runs at something like, I can't remember the exact figures, it's in the order of about 30 trillion, 29, 30 trillion. So if the government pushes in another 1 trillion on top, you're looking at something like 6% increase in GDP. And this spending really is spending. There is one aspect of this which perhaps we should take out, and that is the interest cost, because the interest cost doesn't go directly into GDP. That goes into the banking system. And some of that ends up being spent into the economy. So so what you can see is that even allowing for that, it artificially increases the GDP number. I mean, what the GDP is basically this is the total of the sum total of transactions in qualifying items. So, buying cars, buying, food, buying electronic goods, buying clothes, buying, all the normal stuff, if you like, which is in GDP. What the GDP measure is, it's the sum total of all those transactions by economists, if you like, as a measure of economic activity. This is actually incorrect. What it really does measure is the government's tax base. And that's why governments actually like it. Because it's on the basis of these transactions that sales taxes can be levied. Income is another way, if you like, consumer income is one of the ways in which GDP is calculated. So that also gives you an indication of income tax and also corporate tax on Main Street, and so on and so forth. So it's a very, very good indicator for governments of tax. But what it does not tell you is the quality of goods being bought and sold with that credit. And so that's the way to look at it. That is why it's an entirely false figure. We shouldn't be looking at it in terms of, this is an indication of economic activity, because, the economy can be going to hell in a handcart, and GDP is still rising because the government is spending into, it's debasing the currency and juicing up the numbers as a consequence. That's really what happens.
As gold forecasts unfold, it's crucial to view gold not solely as a precious metal, but as a valuable addition to an investment portfolio. Serving both as a tactical inflation hedge and a long-term strategic asset, gold emerges as a resilient portfolio diversifier and an effective currency hedge, especially against the U.S. dollar. With a conservative annual return estimate of 2-4%, incorporating 10% of your portfolio in gold can significantly enhance risk-adjusted returns. Given the economic intricacies and concerns about the surging U.S. national debt, what do you think about gold's role as a safe haven asset in safeguarding against potential impacts on fiscal strength? Share your thoughts on Alasdair Macleod's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.